Hello, fellow traders. 'Tis I, the Rumpled One. Price action. What else is there? I tell you, I spend time looking at other forums, seeing what other traders do. I don't know it all. I figure I might be able to learn something, but it always boils down to the basics, price action. I've probably talked about this before, but it's okay sometimes to repeat yourself because, repetition is the mother of learning, the mother of skill. That's how you learn, by practice. What is practice? It's repetition. So price action. What is price action? Well, some of you may have received my little document, one-page document, even though I've broken it up to 3 here, on all you need to know about trading. It's really not that difficult. But the point of this video is price action. And there's a quote by Rearden which set me on the path to discover the rat. The quote is, "Now, two patterns of market behavior happen on a regular basis. One, the price breaks to new highs or lows. Two, the price reverses from new highs or lows. This happens regardless of time frame. They are phenomena that can be exploited without fear if found out by others that they might cease to exist." My hat's off to you, H. Rearden. It's so simple. In my own words, it says price will either break out of the high, low, or both of the previous bar, or price will not break out of the previous bar. Now, in case 2, that would be called an inside bar. Now, if price breaks out of both the high and the low, that's called an outside bar. But the main thing to take away from price action is that you cannot reduce this any further. And if you add anything to it, you only complicate the issue. So let's look at some charts and get an understanding. Looking at the British pound right now, and it's a Saturday, the market's closed. But you can see here, price opened. Here's the previous day's high. Price broke out of the previous day's high. It reversed. It came down. Here is the previous day's low. It broke out. And it reversed. Now, I mentioned to you about the rat, and for those of you who've never heard of it, the rat zone is the distance 20 pips between today's high, 20 pips below today's high. Between these two boxes or dots here, this area is the rat zone. And then down here, between the low and plus 20 pips, this is the rat zone. Why 20 pips? Well, when I ran frequency distributions on the size of the wicks of the daily candle, the top wick and the bottom wick or tail, I noticed that more times than not, the wicks were greater than 20 pips. Let that sink in for a little bit. More times than not, the wicks are greater than 20 pips. So what that means is, if you go short in this area, or you go long in this area, chances are price is going to come out of that area. So for example, now the indicator here that's drawing these little spots or boxes, whatever you want to call them, the wingdings, This is the dynamic rat, the TRO dynamic rat. And so what this does is it paints the dots from a historical basis true to what happened at the time. So in other words, when this is the open candle, so here was the low. This was 20 pips above the low. Here was the high, and this is 20 pips below the high. And you can see as the day goes on how they expand. So this indicator does not repaint, and most indicators don't repaint because they run in real time just like price does. But this one, you can look at it in history and it'll show you what happened. So we're looking at 1 hour bars, and you can see here it came down, it made a new low. Came down, made a new low. And you see here it started to retrace out of that low. Then it came down and made a new low. It retraced out of that low. It came down, made new lows. It retraced out of that low. That's the rat zone. So what we're looking to do, and it really doesn't matter what entry method you use, what your trigger is, so long as you get in your trade in that rat zone. Now we can just go right down the line so you can see how this works. Some pairs work better than others. You run the frequency distribution and you can fine tune the rat zone. So you can see here with the Aussie yen, it dropped down, it popped up. And you can see here, once again, it created a wick, that was bigger than 20 pips, because there's the close right there. There's the low. The Australian US dollar. You see here it fell out of the rat zone, popped up a little there. Once again, it came out of that rat zone. The euro pound, and you can see once again, it's coming out of the rat zone. The euro yen comes down out of the rat zone, comes up out of the rat zone. The euro dollar, you can see here, it came out of the upper rat zone, and it just struggled to get out, barely finished above the lower rat zone. The pound franc, you can see the price action there. The pound yen, all the way down and then back up. So you see here, you're waiting, you take your chances. You can see how you can get some of these bounces. You can trade out of the zone here. See here, it came back into the zone, popped up, put in a new low, came out of the zone, put in a new low, out of the zone. What did H. Rearden say? These two patterns happen on a regular basis. The price breaks the new highs or lows, and the price reverses from new highs or lows. We started off with the pound dollar, New Zealand dollar. Here you go down and up, you see. Now the range wasn't that tight, but you see here, once again, it closed out of the zone. It was only about maybe a pip, but it did close out of the zone. The US dollar, Canadian dollar, out of the rat zone, out of the rat zone, new high, out of the rat zone. The dollar franc, oh look, we had a close inside the rat zone. Very rare occurrence. You see here, it's pushing up. And finally, the dollar yen. New high, popped out of the zone, new high, out of the zone, into the lower rat zone, and back up, and back. You see that, how it oscillates? So you see, fellow traders, it really is very simple. Now, I'm not advocating reversal trading. What we're saying is we're either going to have a breakout or we're going to have a reversal. You're going to have one or the other. It's either going to break out or it's not. So you can look here and see it didn't break out of yesterday's high. It didn't break out of yesterday's low. We can go back and look here. Did not break. The dollar Canadian, it broke out. So you could take a breakout trade here. You see here, it didn't break below the previous day's low. New Zealand dollar didn't break out. The pound, we've already saw a tiny breakout. No breakout there. No, we had a breakout right here. It broke out of the previous low, made a new low, and reversed. The euro, no breakout. The euro yen, we had a breakout. Here's yesterday's high. It broke out there. It broke out there. Yesterday's low was down here. The euro pound, you see the new high. We had a breakout right there. Now it looks like it was about a 20-pip break. The Australian dollar, you see here yesterday's low. We had a break. And the Australian dollar yen, here was the previous day's low. We had a break, another break, and reversal. So you see, once again, price will either break out of the high or low or both, or it will not break out. So whether the previous bar is a daily bar, an hour bar, or a 1-minute bar, or a 1 week or 1 month bar, these two statements will hold true. This is price action. You cannot reduce it any further, and anything else complicates the issue. So fellow traders, the takeaway here is to look for price to reverse out of the rat zone, and on the previous day's high or low, look for a break. If it's getting near, trade the break, then you can trade the reversal. That's if you're a Yale student. If you're a rat, you only trade one direction. Red rats trade short, green rats trade long. Yale students trade both ways. And we all know the rat beat the Yale students. So, my fellow traders, it's not what you trade, it is how you trade it. The Rumpled One, signing off.